Why is a trailing stop an important strategy to use? Are they even a good idea? Well, nobody can predict with 100% accuracy where that trend's going to end. And the amount of money that's left on the table by those that are happy to settle for just some small gains, I think is pretty astonishing. So if you're thinking that a trailing stop is only going to make your habit of getting ticked out only to see that market reverse, well, then you're just doing something wrong. And I'm going to list several methods to trail your stop loss. And then I'm going to give you one that I use routinely in my trading. Some people think that trailing stops are confusing. But think, a trailing stop just means that your order to exit when the market moves against you just keeps a certain pace with the price. When your price is rising, the stop's going to follow it. If there's a price drop, the stop will also keep pace, depending on your method, with the decline in price and hit your sell order to exit the market. So an example would be that you're long in Forex or stock and price moves in your direction. Your trailing stop loss is going to continue higher with your price. So the trailing stop order, it sits in the market as a limit order that's just waiting to get hit when price reaches it. When the stop is triggered, the stop loss order is going to act like a market order, which means you could get filled at a worse price than your stop order. So when you trail your stop, you're allowing your position to stay in the market while the trend is ongoing. And if you use price targets, oftentimes you exit only to see the market continue in your direction. And that issue causes a lot of traders to just jump back in the market outside of the rules that are in the trading plan. So if you want the chance really to ride that big trend, and they do happen, and ride it to bigger profits, the trailing stop is going to be your best bet. Now, how you place your stop loss is going to be dependent on your trading platform and your trailing stop method. With Oanda, you can actually set an automatic trailing stop, which will update your stop loss according to your criteria. So in order to understand how to place it, you should really know the difference between a trailing stop and a static stop loss. So a traditional stop loss is an order that you set when you enter your trade. And that's going to be how you're going to limit your risk when you're taking a trade. The stop loss will sit at the price that you have set until price either reaches it or you take your profit. Here, note as the price pulls back, makes new high, on the left side, it had the stop loss remain in place. Now on the right, as price increases, the trailing stop made its way under the new swing as price broke upwards. So what's the benefit? Well, you have some risk that's out of the market, so a stop out is going to be less than the original risk that you put on. And depending on your initial risk amount, you may have booked some profit if price comes back to your new stop location. So the biggest takeaway when you're considering a stop is that with a traditional one, when price moves in your favor, your risk stays the same. A trailing stop will decrease your risk. Also consider as an example, if you risked 50 pips and you set a profit target of 150 pips in Forex, for example, well, what do you do if price is at 130 pips? Do you consider risking that 130 pips that you just made plus the 50 in the stop loss to gain an extra 20 pips? Well, the smart money says, no, don't do that. So there's a lot of ways to trail your stop loss, from using a certain number of days, a price pattern, indicators, even a percentage-based method of doing it. And the first thing I want to say is just say no to percentage-based trailing stops or to a specific dollar amount. And those are simple, an X dollar or cents away from your current price or a percentage of the current price. For example, if I'm using a 25% trailing stop, that would mean if the current price is $10 and you're long, 25% of 10 is 250, so your stop would be set at 10 minus 250 is $7.50. Well, how did you come up with that price difference to use? Why are you using a certain percentage as opposed to another? And it does not account for extremes in market behavior. And while it may seem easy to use a price-based stop, it's probably not one of the better ways to trail your stop. Now, nothing says uptrend like higher highs and higher lows, so why not take advantage of a common trending pattern for our stop loss trailing method? So this trailing stop here, this is a chart of Costco. It's been a pretty good run to the upside until the end of 2018. So I want to assume that you bought into the uptrend around the area of that yellow splash right there. At number 1, this is our initial stop, and that's going to remain static until the recent price high is taken out. So we need higher highs to confirm an uptrend. So if we move it too soon, we could be taken out by just normal price fluctuations. At number 2, this is the swing high that we need to see taken out. And we can see in the middle of the chart that price breaks the line and starts to trend upwards. At number 3, now we use our trailing stop strategy. We bring our stop under the pivot low. Some may use the lows just prior to the low of 3, and that's just a personal preference. At number 4, price ranges in a breakout and trends to the upside. And so that's still a sign of an uptrend. Our new stop is now below the lows. At number 5, we had a really long run to the upside, and this move, it's more of an exhaustion move than a continued trending move. We can aggressively move our stop to the middle of the momentum candle or just a bit lower. So this trade would get stopped out, but not before making a 29% move to the upside. So when you're looking for the location below the pivots to place your stop, don't just place them in the stop hunting territory. An ATR or looking left and looking for another price location, such as the opening of a momentum candlestick that is around the pivot, makes sense. So another method that we can use involves an indicator like Bollinger Bands. So we could trail along the moving average, and some will say that you're using dynamic support or resistance. It's not true. And using a moving average, well, it's better than random placement. It's not something that I really consider using. But what about using the average as a central location and then the standard deviation property of the Bollinger Band? So this way, we give the market room to move, and we lessen the chance of being taken out just before a move really starts in our favor. So I want to assume that you were bearish on the left, and after a momentum move and a lazy pullback, you entered around the yellow splash. Your trailing stop strategy would be to wait until each daily close, read the price point of the upper line to define your new stop price since we're short. This is a 5.5% move to the downside, and you're taken out with momentum. So now we turn to longs after that momentum move and after a pullback that's lazy. Now we never want to trade a corrective move that has momentum in it. So now you buy the yellow splash. And as of this chart here, you've locked up 4% in your position. Now markets go through times of low and high volatility, and using an indicator like the ATR, we can take advantage of the increase or the decrease in the range of price movement. As the average price range decreases, we might want a tighter stop due to the adverse moves oftentimes being pretty aggressive. When the average price change increases, we want to give the market room to run to take advantage of that volatility. Sudden price shocks in your direction would require a more aggressive approach. So the ATR trailing stop is going to take into account the volatility of the past X number of days and give you an average price. It's also going to take into account big and small price movements, so you're staying in tune with the market. Here we got a 20 period ATR with a multiplier of 2 for our trailing stop on Japanese currency futures. So in this example, we're considering the 50-day average as our trend direction. So even though price breaches the average, there is no price acceptance and the average slope that stays downwards. So we only consider shorts until the right side of the chart where price gaps up and over the average. So the red line on the chart is a 20-day average true range times 2. At the close of each day, you would adjust your stop location to the ATR price level. And you can see that for the majority of shorts, you do get a good run of price movement before the trailing stop is triggered. Now also note that as price forms small ranges, the average true range stop location gets closer to price. When momentum steps in, price pulls away further from the stop location, which is really good for profit accumulation. Now on the right, we consider the green line our stop level as price heads to the upside, where we are eventually taken out. So regardless of using price action or volatility indicator for your stop, moves that are outside the recent price data can skew your stop placement. So oftentimes, as we see in the JPY futures chart, gaps and large price moves can often spell the end of the current leg of price movement, or in some cases, change the direction of the short and the long-term trend. So what do? You lock in the gift that the market just handed you. So let's look at this chart again. So a trend channel, it shows the rhythm of the market, and strong price moves outside of the channel is something that we want to take note of. So in this example, you could place your trailing stop under the low of the candle that broke the upper resistance line, which would lock in more profit than the ATR trailing stop. So markets that have moves like this often have a sharp snap back in price. And while we could never know if price is going to continue, we also don't know when the price is going to slam back against us. So we want to err on the side of caution when the probability of a reversal is strong, and that is sensible trading. So what if we just had a strong momentum candle and not a gap? Use the middle of the momentum candlestick, which does give you a tight stop, but it allows more profit potential than the original ATR. You keep using price actions such as the next candle that's printed here. So what can happen is the market will stabilize and you could continue to go back to using the ATR trailer. Now, people are always looking for that best way to trail their stop and to enter trades. The truth is, though, there is no best. What's important is that you set a trailing stop if you are looking to make bigger gains in your positions. I personally prefer using a volatility-based trailing stop along with using price action, which means just adjusting for the price moves that are outside the normal range of price. Using trend lines doesn't make too much sense because when price pokes below them, for example, you want to be a buyer and not selling on the reversal. So really, the best trailing stop is one that you understand, one that's going to allow you to ride the trend, and one that you are consistently going to use.